It was 2008, and the global financial system was coming apart. Major banks were collapsing. Emergency phone lines were overloaded. Millions of people were losing their homes, their savings, their trust. Governments rushed in with massive bailouts, pouring hundreds of billions of dollars into the very institutions that had caused the disaster. For ordinary people, the message was clear. When banks fail, the public pays. Confidence in financial systems evaporated almost overnight. Faith in governments followed close behind. Anger spread everywhere, and the world felt primed for something, anything, that challenged the status quo. Then, quietly, something appeared. On October 31st, 2008, an unknown individual, or group, using the name Satoshi Nakamoto, released a short technical paper online. It didn't look revolutionary at first glance, just a PDF. But inside it was a radical idea. What if money didn't need banks? What if trust didn't require governments? What if math could replace middlemen? Satoshi proposed a digital currency that no central authority could control. No printing money on demand. No bailouts. No hidden manipulation. Transactions would be verified by a public ledger anyone could inspect, but no one could alter. On January 3rd, 2009, the system went live. The first Bitcoin block, later called the Genesis block, was mined. Embedded within it was a message referencing the bank bailouts of the time. It wasn't subtle. It was a statement. This wasn't just technology. It was protest. Bitcoin wasn't born from greed or speculation. It was born from frustration, anger at broken systems, and the belief that money itself needed to change. At first, almost nobody noticed. Bitcoin was a curiosity shared among cryptography enthusiasts and programmers. It had no price, no market, no real-world use, until one moment changed everything. In 2010, someone made an offer that sounded ridiculous at the time. 10,000 Bitcoins in exchange for 2 pizzas. The deal went through. For the first time, digital coins created by code were traded for something tangible. Food, value, proof. The pizza was eaten. The Bitcoins were spent. And without anyone realizing it, history had been made. At the time, it felt meaningless. In hindsight, it tasted like the future. Those 2 pizzas would later be valued at hundreds of millions of dollars. But the real lesson wasn't about money, it was about meaning. One of the biggest financial revolutions in history didn't begin in a boardroom or a government office. It began with takeout food. Bitcoin wasn't just a new type of currency. It was a challenge to the old system, and that challenge was only getting started. To understand why Bitcoin mattered, you first had to understand its core invention. Imagine a notebook. Not an ordinary one, but a notebook copied across thousands of computers around the world. Every time someone writes a new line, every copy updates. Try to erase a page and the other copies immediately prove it never happened. That notebook is the blockchain. Every transaction is recorded publicly. Once written, it can be changed without rewriting every copy of the ledger at the same time. An almost impossible task. This design removed the need for trust in any single institution. No banks, no central authority, just math and verification. So who keeps this system running? That role belongs to miners. Miners are computers competing to solve complex mathematical problems. The first one to solve the puzzle earns the right to add the next block of transactions to the blockchain. As a reward, they receive newly created Bitcoin. This process is called proof of work. It's a global competition that requires real energy, real effort, and real cost. That cost is what secures the network. Cheating would require enormous resources, and even then, success is unlikely. Bitcoin also introduced something unheard of in traditional finance: a fixed and transparent supply schedule. There is no central bank, no emergency printing, no sudden increase in supply. Every 4 years, the reward for mining new Bitcoin is cut in half. In 2009, miners earned 50 Bitcoin per block. In 2012, that dropped to 25. In 2016, it was reduced again to 12.5. Like slicing a pizza into smaller and smaller pieces as more people joined the table, scarcity was built directly into the system. For the first time, money followed rules that couldn't be changed by politicians, banks, or powerful insiders. At first, almost no one cared, but that was about to change. After that, the rewards kept shrinking, from 12.5 Bitcoin per block to less and less again, until around the year 2140. When the final Bitcoin will be created. After that, there will be no more. Ever. That fixed supply changes how people think about money. In traditional systems, spending quickly often makes sense. Prices rise over time, so holding cash feels risky. If money loses value every year, saving becomes a losing game. Bitcoin flips that logic. When supply is capped, holding can be rewarded. Instead of rushing to spend today, people start thinking long-term. Value isn't constantly diluted. Patience suddenly matters. Governments handle crises by printing money. It's fast, familiar, and politically convenient. But the side effect is unavoidable. When more money enters the system, each unit is worth less. Bitcoin has no central bank, no emergency button, no way to create more on demand. The maximum supply is locked at 21 million coins. During the early 2020s, massive amounts of new currency entered the global economy. At the same time, Bitcoin's inflation rate was mathematically declining. In a world built on easy money, Bitcoin positioned itself as hard money. That comparison sparked a new nickname: digital gold. Gold is valuable because it's scarce, durable, and widely trusted. Bitcoin shared those traits, but added something gold never had. It could be moved instantly, across borders without permission. Ownership could be stored in a small set of recovery words. Millions of dollars could exist without physical weight. Verification was just as radical. Instead of trusting an institution, anyone could independently confirm transactions by checking the blockchain. Transparency replaced authority. That's when major players began paying attention. Some corporate leaders treated Bitcoin as digital property, something to hold, not trade. Others argued that even small institutional adoption could dramatically change its value. Tech leaders suggested it could become the native money of the internet itself. Not everyone agreed. Critics remained loud. Volatility scared traditional investors. But one thing was undeniable. Bitcoin was no longer a joke. It was no longer niche. And it was no longer ignorable. The experiment had survived, and now the real test was beginning. Bitcoin is no longer just an idea. It's being tested in the real world. Some countries have gone further than anyone expected. In 2021, El Salvador adopted Bitcoin as legal tender. For many citizens, this meant sending money home without losing 10 to 20% to remittance fees. Transfers became nearly instant and dramatically cheaper. The government even announced plans for a Bitcoin-focused city powered by geothermal energy from volcanoes. In other parts of the world, Bitcoin found different uses. In countries like Nigeria, it became a way to receive global payments and protect savings from currency instability. In places facing extreme inflation or conflict, such as Argentina, Ukraine, and Afghanistan, Bitcoin helped people move value across borders, preserve purchasing power, and remain financially connected when traditional systems failed. Today, hundreds of millions of people use cryptocurrency worldwide, with Bitcoin still dominating the space. Institutions have taken notice. Major financial firms began offering Bitcoin-related products and services. Large asset managers explored exposure. Public companies experimented with holding it on their balance sheets. What was once dismissed as fringe technology was now being discussed in boardrooms. But acceptance has never been unanimous. For every believer calling Bitcoin digital gold, there are powerful critics who see it as worthless. Legendary investors argue that Bitcoin produces no cash flow, no income, and no tangible output. It doesn't grow food. It doesn't generate rent. By traditional valuation models, it appears unproductive. From that perspective, the criticism makes sense. Bitcoin isn't a business. It doesn't generate earnings. It doesn't pay dividends. But that's also the point. Bitcoin isn't trying to be a company. It's trying to be an asset, more comparable to gold than to stocks. Its value comes not from productivity, but from scarcity, durability, and trust in its rules. Even some of its loudest critics have quietly adapted. Financial institutions that once mocked Bitcoin later introduced crypto services of their own, responding to client demand rather than ideology. The debate hasn't gone away, it's only matured. Yet beyond criticism lies a deeper uncertainty, one that has nothing to do with price or regulation. Bitcoin's creator vanished. Satoshi Nakamoto launched the system, mined the earliest coins, and then disappeared completely. No interviews, no explanations, no return. The wallet believed to belong to Satoshi holds a massive number of Bitcoins, never moved, never spent. That silence is unsettling to some, reassuring to others, because Bitcoin doesn't belong to its creator anymore. But the question remains, was Bitcoin designed to survive everything, including the absence of the person who started it? And if the system is ever truly tested, will its code be strong enough to hold? A common fear still lingers. What if Bitcoin's creator returns? What if those early coins are suddenly sold? Could the system be taken over by the person who built it? The short answer is no. Bitcoin's code is open source. No single person, not even its creator, has special privileges. Any meaningful change to the network requires broad agreement from thousands of independent participants, miners, developers, and node operators spread across the world. Even if Satoshi Nakamoto reappeared tomorrow, control wouldn't return with them. Bitcoin no longer belongs to its creator. It belongs to its users. Then there's the next big concern: technology itself. Quantum computing is often described as a future threat, capable of breaking today's cryptography. But practical quantum machines remain far from that level, and Bitcoin developers are already researching and preparing for quantum-resistant upgrades, long before the risk becomes real. What about governments? Many have tried to restrict or ban Bitcoin. Some have succeeded locally, others have reversed course. But Bitcoin isn't a company with a headquarters. It has no central server to shut down. When one country restricts it, the network adapts and continues elsewhere. That's already happened. Mining operations have moved across borders. Nodes have redistributed. The system has proven capable of surviving pressure from some of the most powerful governments on Earth. And then there's competition. Newer blockchain projects promise faster speeds, greater flexibility, and more features. Some may thrive in their own niches, but Bitcoin was never designed to be flashy or experimental. It was designed to last. Bitcoin is intentionally simple, slow by modern standards, conservative in design. Every limitation exists for a reason: security, predictability, resilience. So what is Bitcoin's real advantage? It isn't speed. It isn't convenience. It isn't perfection. It's survival. Through crashes, bans, criticism, hacks, and countless predictions of its death, Bitcoin remains operational, still producing blocks, still settling transactions, still following the same rules it started with. Maybe that's the point. Not to promise a perfect future, but to prove that some systems can endure one.